Hi again, and in this topic video we're going to take a look at the economic importance of investment, both as a component of aggregate demand and also affecting the supply side capacity of economies. Investment is spending on capital goods. These are any man-made products used in the production process. So it could be factories, machinery, new technology, buildings, all that kind of stuff. That's investment. And investment remove resources from current consumption, but of course they increasingly add to our productive potential in the long run. Now, investment, of course, is part of the C plus I plus G plus X minus M formula for aggregate demand. It's an important but a volatile component of AD, and it's crucial to understand investment if you want to get a good feel for the factors that drive competitiveness of countries in the long run. In Britain, around 75–80% of investments done by the private sector businesses such as British Telecom or Tesco or Tutor to You, the big ones. About 20–25% of investment, though, is done by the public sector, government investment, and we won't forget that. That's important. Now, I need to make a distinction between gross investment and net investment. Gross investment is simply the total spending on capital goods. Okay, that's all it is, just gross, it's the total. Net adjusts for the fact that we need to spend some money every year just to replace worn out, technologically obsolete capital machinery and buildings and other types of capital input. So some investment is needed every year, if you like, simply as replacement investment. And if we take gross investment minus capital depreciation or capital consumption, we get a figure for net investment. Now, if total investment, gross investment in a given year is higher than capital consumption, higher than depreciation, that means net investment will be positive and the size of a country's capital stock will grow, will get bigger. Now, what are the key factors affecting the level of investment? Let's go through some of them. Before we do that, I want to emphasize the importance of expectations. If you're writing about investment, an economics essay, investment decisions involve oftentimes decisions that are going to bear fruit hopefully over 5, 10, 15, 20 years sometimes. So business expectations are crucially important if you want to understand the actual level of investment. And equally, the sort of overall level of uncertainty in the economy can play a part there, particularly if there's political uncertainty. For example, the Brexit debate in the UK in the summer of 2016, and uncertainty about future taxation, that kind of stuff. Let's focus on 4 key factors that influence capital spending by businesses. The first one is the actual level and rate of growth of demand. So we've covered this in a separate topic video. If you want to Google Tutor to You accelerator, you'll find a little topic video on the accelerator model. But basically, when the actual level of demand and the expected level of demand is pretty strong relative to your existing capacity, then there's often quite a strong pressure for businesses to ramp up their capital spending. So consider, for example, the telecommunications companies who are trying to fast forward their capital spending to give the system the capacity it needs to live in a world of big data. Another key factor, and again, notice the word expected coming into this graphic, is expected profit and also business taxes. So when a business is thinking about the risk factor of making an investment, and all investment in capital involves an element of risk, then they might be thinking about the expected return on capital and also how much profits they might have to pay in tax. So the corporation tax rate could be important, or there could be some tax allowances for particular types of investment spending. A third factor, as you would expect, I suppose, are interest rates in the economy and the availability of business finance. So this is essentially the cost of capital to a business. Either the rate of interest at which they have to borrow, they're going to fund the investment. Not every business has the cash to pay for their investment, or the rate of interest is the return they could have put on its money if they'd invested their money in, let's say, in a bank account or some other financial instrument. Either way, we would expect to see the level of planned investment to be inversely related to the prevailing interest rates. That's not to say that low interest rates will necessarily cause a boom in investment, because other macroeconomic factors could be working in a different direction. But normally, when interest rates are falling, hopefully, the level of investment will go up. And I've mentioned there the availability of business finance. That's hinting at the importance of the supply of credit from the banking system. That's been an issue recently. Or perhaps the ability of businesses to go to the capital markets, raise some equity through shares to fund investment, or to go to the bond markets and issue some long-term bonds. That's important too. Now the bottom right is the key one. I think this is the one I would take away from this slide, that planned investment is really determined by confidence. And of course John Maynard Keynes called this animal spirits. The returns from investments will be flowing in at some future date, so therefore you have to have the confidence to make a purchase of capital that money will bear dividends. So business confidence is really important. Take a moment to think about this slide. There are four key factors here: demand, expected profits, cost of capital, and business confidence. They all work together, as do so many things in macroeconomics, to impact on investment demand. Time for a little bit of data. I know you love these charts. This data shows capital investment spending in the UK as a share of our GDP. And I've expressed it in two ways. One is simply in cash terms, in money terms. That's the blue bit, the nominal level of investment. And that's been falling actually quite sharp in the last sort of 20 years or so. And the real level of investment as a share of GDP. This is business investment, by the way. And that's been more or less steady, but it's pretty low in terms of total. We have to factor in some government investment to get the bigger picture, but investment spending in the UK has not been substantially higher than in the last 5-10 years. And that can be a problem. What about some international comparisons? I think this is quite interesting data. This is for 8 years, 2005 through to 2013, and it shows the level of capital investment overall, including the state sector, as a share of GDP. Look who is right up at the top. China has invested, over this period, nearly half of their national income in gross investment. Keep in mind there'll be some depreciation as well, but gross investment. Mongolia right up there. Presumably they've discovered and are extracting some natural resources, and a very small economy, so a big investment project will be a big percentage of GDP. Big investment rates in Ethiopia. Successful manufacturing country South Korea. Australia, quite high investment rates there, nearly 30%. India likewise. So quite a few countries have an investment percentage of more than a quarter, in some cases more than a third of their national income. And I know what you're thinking. Where is the UK? You've missed it out. Well, the UK is a little bit further down the list. And there we are. Our gross investment spending over the period 2005 to 2013 has averaged just over 16% of our GDP. Now that's substantially below countries like South Korea. You might expect that. It's well below countries like Germany and the United States and the Ivory Coast. So does Britain have a lack of investment problem? Are we investing sufficient of our national income into new capital, new machinery, new technology? I'll leave that for you to think about. Before I do, think about Greece, and this is just up to 2013. Things may have got worse since, but Greece is way down the list in terms of developed countries, in terms of their investment. There's been a collapse in capital investment in Greece for obvious reasons. Cuba is, of course, starting to open up its economy with the improving political relationships with the United States. So one could expect investment in Cuba, particularly from overseas, to start picking up quite sharply in the years to come. That's one to watch. Finally, I just want to take you through a little bit of theory and hopefully improve your evaluation as well, help you on this one. Oftentimes there'll be an exam question saying, consider the implications of a rise or an increase in business capital spending. Why is investment good for the economy? A lot of people say it's triple powered. It affects demand, it affects supply, it affects profitability. So what are the advantages of higher investment? Well, one, of course, it's an injection into the circular flow model, C plus I plus G plus X minus M. So you should expect that to be an important point to make. If we can get some more investment to the UK, it'll help stimulate demand. That's good news, and there could be some multiplier effects. How do we evaluate that? Well, some of the investment's good, some of the technology, some of the machinery might be imported, which of course is a leakage from the circular flow, and that would dampen the size of the investment multiplier. Crucially, I think new capital can boost, if you like that word, boost productivity, and it creates increased productive capacity. Think about the PPF curve shifting out, or think about an outward movement of the long run aggregate supply curve. So that's important for the supply side, lifting output per worker and capacity to supply. On the other hand, it could well take a lengthy time period between workers receiving their gleaming new capital equipment, getting trained properly to use it, and harnessing the new technology at their disposal. I think the important point is the multiplier, that if you invest in a new factory, in a new manufacturing capacity, then there's going to be an increase in demand, not just for the goods and services that you produce yourself, but also what's called the capital goods industries. Who's going to make the machinery? Who's going to make the buildings? So there could be quite a strong investment multiplier. Equally, some investment could be labour saving. So think about investment in robotics, capital intensive investment goods, which in theory lift productivity, but of course they destroy some jobs and could cause some structural unemployment. I think if you get a question on investment, I would always be looking to make the point or make the link, the synoptic connection between investment and overall competitiveness, and then flow it through in terms of the impact on the trade balance in the future. So countries which invest significantly in capacity and exploit economies of scale and get their unit costs down in relative terms should become more competitive, and that will be an addition to their growth potential. On the other hand, there are many factors that affect price and cost competitiveness for a country. It's not just investment, it could be the exchange rate, and a whole host of non-price factors. So in theory, investment's good for the economy, and I think Britain could do with some more investment, particularly the infrastructure side, but it's always good to be thinking in evaluative terms about some of the likely consequences. So there we go. Over the last 10 minutes or so, we've just touched on some of the key aspects of investment in this little revision tutorial. This is all part of your study of aggregate demand and the economic cycle. I hope you found it useful, and if you have, maybe you'll check out some more of our revision tutorial videos on the YouTube side. Take care and see you soon.